Global markets dropped yesterday after U.S. President Donald Trump's latest tariff threats. However, he is extending the deadline, essentially, on many countries till August 1st. Let's get more on this apparent calm in markets from Lance Roberts, Chief Investment Strategist at RIA Advisors. Lance, great to see you. So generally, do you agree with the thesis that the market has generally become accustomed to Trump's rhetoric and tactics on trade and is largely shrugging it off?
Yeah, no, it's pretty much the case. After the Liberation Day, one of the things that we talked a lot about here was that markets are going to start to look through tariffs pretty quickly. Tariffs are not the inflationary impact that a lot of people thought they were going to be. And again, if you take a look at recent inflation data, they're not really showing up in inflation data as of yet. This is largely because consumers have to, make choices, and so producers wind up eating a lot of the tariffs before it actually gets to the consumer side. So companies are starting to look through this issue now, and markets are looking through it because, what markets want to know is this going to impact earnings? And so far, there's not been really any case of that just yet. So markets are getting a lot more exuberant here about the fact that a lot of this has been stick and carrot with President Trump. I'm going to tariff you, then I'll give you a pause, and I'm going to put a tariff on you now, and we're going to work it out. So a lot of the markets are now just kind of looking forward, saying, okay, this will eventually resolve itself. We'll probably have somewhere around 10, 15% tariffs. That's reasonable. Markets can live with that. That doesn't have a huge impact on earnings. And so markets have been very bullish really since then.
We did hear about this supposed flight from U.S. equities or U.S. assets. I guess we did see signs of that in April. President Trump, for example, at one point was concerned about falling bond prices. But now equity markets are back at record highs.
Yeah, and early this year, we saw a bit of rotation from U.S. equities into international markets, and that's not really surprising. We've had 2 strong years, 20% plus return years the last 2 years. Seeing a bit of rotation in international markets was kind of expected, but the reality is that when you get down into earnings growth, where earnings growth is occurring is in the U.S., primarily in the big mega cap companies, the artificial intelligence companies, the Palantirs of the world. That's where the earnings growth is. So now markets are starting to realize that, and we're starting to see a lot of foreign inflows back into U.S. equities, and that'll probably persist here at least through the summer.
The Magnificent Seven. I always think that's a Marvel Universe movie. I'm not sure if you saw Scarlett Johansson is now the highest earning actor in history on her cumulative box office. I mean, her box office take. In any case, have investors, have they fallen back in love with the tech giants?
Yeah, to some degree, it's really more like the Mag 3 now, more than the Mag 7. Tesla's really kind of fallen on some rough times lately because of political intrigue more than anything else. But, we're starting to see a bit of rotation now in markets. So yes, the NVIDIAs of the world, the Microsofts, those have been grabbing some inflows lately because of basically their size and weighting in the index. But we're seeing a lot of money flow into the AI darlings now, which have now shifted down into smaller mid-cap companies like the Palantirs, the Palo Alto networks of the world, the CoreWeaves. Investors are really starting to look at this AI generation, and not only just in the companies generating the AI itself, but also in the infrastructure behind that, the power generators like GE Vernova, as well as Oklo for the nuclear power. So we're starting to see a bit of a broadening in that AI story, which is healthy. But, this reminds me a lot of the internet chase back in the late 90s. We've got to get in early, got to get in now, and we'll eventually sort the winners out down the road.
Just looking at a scorecard for the Mag 7, Meta Platforms is up about 23% this year. And then, as you note, Tesla is down 25%.
Yeah, again, you need to pick your battles, and I don't think political intrigue was the battle to pick for Elon. But I think it'll work itself out. Particularly with some of the innovations in the EV space, as well as SpaceX and a lot of other things, I think Tesla is going to do better in the future. But again, it's got to kind of work through this, kind of battle he's picked with the White House right now.
I got to admit, AI search is getting better. Today I needed a quote from Lewis Carroll from Alice in Wonderland or Alice Through the Looking Glass. I can't remember. I thought it was the Mad Hatter. And AI, ChatGPT told me, no, it was Humpty Dumpty. And here's the quote. So it's pretty impressive what this stuff is doing right now. What is your view? What is your view on bond? Sorry, Lance. What is your view on bond yields?
Bond yields right now, they're trading about where they should be. If you take a look historically, bond yields track inflation and economic growth. So, economic growth is around 2.3%. Inflation's running about 2.3, so that's 4.6 altogether. Bond yields around 4.4%. So that's about where they should be. But as we look forward in the course of the next year or two, we're going to see slower economic growth. Even the Fed's predicting sub 2% economic growth. Employment data, while still strong, is definitely slowing down. So, we're very likely going to see sub 4% yields sometime next year. And that'll be kind of get things back more in line, and particularly if the Fed starts cutting rates more aggressively next year to offset any real economic weakness, we'll see yields closer to 3%.
Give us your thoughts on the U.S. consumer. I mean, we've heard an awful lot about the lower income consumer hurting. What about stocks, classic consumer stocks? Not necessarily talking about individual names, but such as Walmart. Are you interested in that sector?
Yeah, we actually own, we have just full disclosure, we own Walmart. Okay. We also own Costco as well as Amazon. Amazon's more discretionary, but the reason we own those, Walmart and Costco in particular, is because consumers are going to migrate down. As when you start to see the issues of even tariffs, just the fact of tariffs, but also weakening revenue earnings growth in terms of incomes, weakening employment growth, they're going to start to become more conservative and step down. Walmart is the low-cost producer. Their prices run about 12% less than comparative stores in that space. Costco does a great job in bringing down costs, and they build a huge profit margin through memberships. Mm-hmm. So those are the type of companies I want to own in a time where you're starting to see economic weakness. Staples will start to, they've been really underperforming here as of late, but I think we're going to see that a bit more of a rebound if we see this market start to weaken in August, September. If the economy does slow down some more, I think we'll start to see a more defensive play into staples. So, companies like Procter & Gamble, Coca-Cola, those are going to be companies that can weather a downturn in the economy.